If you've paid off your mortgage, you've achieved quite the milestone, my friend. Many people never accomplish this, and if they do it, it takes decades to do it, so you should be proud. Not having a mortgage can be incredibly freeing. There's no more stress of making the mortgage payment, and you can start preparing for retirement or other goals. Not to mention how much your net worth increased when you owned your home free and clear. But there's one big question most people have. Is house insurance cheaper without a mortgage? The answer isn't what you might think. In this video, we'll talk about if you need homeowners insurance after paying off your mortgage and if there are any cost savings that you will experience. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree and live financially free. If you like what you hear today, please do me a favor and give me the YouTube triple thanks. That's hitting the like button, subscribe to the channel, and then commenting something nice down below. That would be great. Thank you so much. All right, let's jump right into it. First, let's talk about if you need homeowners insurance after you pay off your mortgage. The law doesn't require it like they do with auto insurance, so no one requires you to have it after you pay off your mortgage. However, there are reasons you still want it. Mortgage lenders require home insurance for all borrowers because it protects both parties. For example, if you had a total loss, such as a fire, the insurance company would pay for rebuilding your house. This ensures you and the mortgage company don't have a total loss. After you pay off your mortgage, you don't have a lender that requires insurance. But just like when you had a mortgage, home insurance protects you. So, what would happen if you had a major disaster in your home? To protect your finances, carrying home insurance is a smart decision. Well, what happens if you don't have homeowners insurance, you might ask? Well, if you don't have homeowners insurance, you are responsible for the costs of all damages that might occur. This doesn't just mean a house fire or tornado wiping out your house. This includes vandalism, theft, weather damage, frozen pipes exploding, and falling objects. These are just a few examples of home damage issues you can experience, costing you thousands of dollars. Without home insurance, you'd have to cover the cost of repairs for any issue that happens to your home. According to the Insurance Information Institute, the average homeowner's insurance claim is around $14,000. That's a lot more than what most home insurance premiums would cost for a year. Well, you might be thinking, okay, fine, I'll keep my homeowner's insurance after paying off my mortgage. But is the insurance cheaper without a mortgage? The answer, unfortunately, is no, it's not cheaper. Here's why. Insurance companies take the same risk insuring your home whether you have a mortgage or not. The mortgage company requires you to have home insurance, but it doesn't make the policy more expensive. You'll likely need the same coverage after you pay off your mortgage unless something drastic changes with your house, making it worth less than before. However, a loss is a loss, and it costs the insurance company the same amount of money to pay your claim to rebuild your home or fix the damages, whether you have a mortgage or not. The good news is that there are ways to make home insurance cheaper. Even though paying off your mortgage doesn't affect your house insurance premiums, these factors can help lower them overall. Number one, determine if you can afford a higher deductible. If you carried a low deductible when you originally bought homeowners insurance, consider if you can afford a higher deductible now. This can lower your premiums. Check your budget to see how much you can afford to put aside for an account strictly for your deductible. If you don't have an official budget yet, consider using an app like Mint to create one. It's fast and easy and helps you stay on track with your spending and your saving. If you can afford to increase your deductible, your premiums will decrease. The typical deductibles are $500, $1,000, and $2,000, but you can talk to your insurance agent about any deductible you think that you can afford. Remember, your deductible is the amount of the damages you must cover before your home insurance reimburses for any damages. So don't overdo it. Number two, ask about discounts. Most insurance companies offer discounts, but you have to ask for them. For example, if you have car insurance and bundle it with the same insurance company that you have for homeowners, you might get a discount on both policies. Most insurance companies also provide discounts if you install a security system, opt into paperless billing, or set up auto payments. Each insurance company offers different discounts, so always ask what discounts are available for you. Number three, limit your claims. The fewer claims you have, the less risk you pose to the insurance companies. Claims can increase your premiums by as much as 20% or more. Only file a claim for significant issues and pay for the smaller issues yourself. Even though it feels like you should use your insurance because you pay for it, you'll usually save much more money paying for the damage and leaving your insurance alone. Number 4, shop around. Every year or couple of years, shop around for cheaper home insurance. You might find more affordable premiums changing insurance companies every couple of years because most insurance companies have lower rates for new customers to entice them to switch. Our family has bounced back and forth between State Farm and Progressive and Geico, and we've saved thousands of dollars, especially when you bundle homeowners and auto insurance together. So sometimes you just gotta switch. Let's talk about some steps to take after paying off your mortgage. After you celebrate your new mortgage-free life, there are a few more steps to take with your homeowner's insurance. Notify your insurance company that you paid your loan off. Your lender's name is on your insurance policy because they own a part of your house. If you had a loss, the insurance company would make the claim payment to you and the mortgage company. After you pay your mortgage off, the lender shouldn't be on your policy anymore. It's up to you to notify the insurance company though. Send them a copy of your paid in full letter to prove they can remove your mortgage company. Change your billing details. If your mortgage company handled your insurance payments, you'll be responsible now that you no longer have a mortgage. Give your insurance company the correct billing address or set up automatic payments. Some insurance companies offer a discount for this option, so consider it if you're comfortable. Add your insurance payment to your budget. Now that your mortgage company isn't making your insurance payment anymore, you have to adjust your budget. The good news is that you can take your large mortgage payment out of your budget, but don't forget to add the insurance premium to it. Using a budget app with reminders of when your bills are due can be the easiest way to remember, especially as you get used to paying your insurance bill. Don't forget, along with your home insurance, you must also pay your property taxes after you pay off your mortgage. Property taxes can be a much larger expense than home insurance, so budgeting is essential. If you had an escrow account with your mortgage company, you paid 1/12 of your property taxes with your mortgage payment. Your mortgage company put the funds in a separate account and paid your property taxes when they were due. Now it's your responsibility. When you receive your tax bill, pay attention to how to pay it. Most counties have an online option, but you may also pay in person at the assessor's office or mail a check. The best way to plan for your homeowner's insurance and property taxes is to create a sinking fund. Have 2 separate accounts or savings buckets with an online account, and it can help you avoid missing your funds on these dates. The easiest way is to divide up each bill amount by 12 months and put that amount aside in an account earmarked for property taxes and home insurance. Keep in mind that if you don't pay your property taxes on time, you risk having a tax lien on your property. Ugh. It's just as serious as not paying your mortgage, so take the sinking fund for your property taxes seriously. Of course, home insurance is important too, because without it, a loss could leave you and your family homeless. In the end, the answer to is house insurance cheaper without a mortgage is unfortunately no, but there are other ways to keep your costs down. Remember though, that after you pay off your mortgage, you must make your home insurance and property tax payments on time. They are now your responsibility, so revamping your budget and keeping your budget apps up to date is the key to success. Well, enough from our side, everyone. We want to hear from you. Were you wondering if house insurance was cheaper without a mortgage? I know I was when I paid mine off. Were these tips helpful in managing your post-mortgage free obligations like insurance and property taxes? Well, please let us know in the comments below. This is Andy Hill from Marriage, Kids, and Money, signing off. Carpe diem.